Think about the relationship between a honeybee and a flower. So, honeybee requires flower for its nutrition. It derives food from it, while flower gets pollinated by honeybee. So, they are very important for each other. Thus, some symbiotic relationships are very critical for one another, be it ecosystem or business. Today, we are going to talk about a company for which I know that you must have consumed its products, whether knowingly or unknowingly. Hi guys, I am CA Panjul Agrawal and today we are going to talk about India's second largest FMCG company. It is the part of Green Portfolio's HQRP portfolio since January 2022 and it has given our client a whooping return of over 200% in just 3 months. I am talking about Adani Wilmar Limited, or as India commonly know it as
फॉर्चून राइस ब्रांड हेल्थ हेल्दी से भी ज्यादा हेल्दी ऑयल.
what started off as a joint venture between the Adani and the Wilmar Group is now a part of almost every Indian household and has a range of products that form two-thirds of the average spend of Indian household. In this joint venture, Adani Wilmar gets in-depth understanding of local market, extensive experience in domestic trading and advanced logistic network in India from the Adani Group, while it gets Wilmar's Group's global sourcing capabilities and technical know-how. So in short, the parentage not only provides Adani Wilmar Limited with global linkages for the procurement of raw material, but also makes sure that the product of the company reaches to the shelves in no time. This is the very first reason why we like the company. Its strong parentage is definitely a competitive advantage for the company. There are 6 major kitchen essentials: edible oil, wheat flour, rice, pulses, sugar, and dairy. So Adani Wilmar is the only company that operates in 5 out of 6 segments of these companies. Now, the products of Adani Wilmar can be divided into 3 segments: edible oil, food and FMCG, and industry essentials. So, edible oil forms around 81% of company's total sales. If we talk about the portfolio, the company has the largest edible oil portfolio in India, which consists of all varieties of oil to capture a wider customer set, the masses as well as the premium, which also lowers the portfolio concentration risk. Now, the market share of Adani Wilmar is 2 times the share of its nearest competitor, thereby giving it a clear market share in edible oils. This also makes Adani Wilmar the largest importer of edible crude oil, giving it higher bargaining power and better quality of raw materials. Now, you would say that this also means higher dependence on import and problems relating to it. See, Indonesia accounts for 70% of the palm oil imports of our country. So in the event of temporary ban of exports by Indonesia would affect all the FMCG companies in India. But the strong parentage of Adani Wilmar is going to help it in such an unforeseeable circumstances, as the Wilmar Group is the largest supplier of palm oil in the world, with a presence of over 90 countries. And Adani Wilmar is also dependent for almost 30% of its raw material procurement from the Wilmar Group. If we talk about the food and FMCG segment, the company is growing staples basket by launching new products. Also, you must have realized that how we are moving from unbranded and loose items to packed and branded ones. Like instead of buying wheat and grinding it in flour, now we are directly buying the wheat flour from the market. Similarly with rice and besan too. Thus, we see there is an immense capability in the food segment to shift from non-branded to branded, especially after COVID. If we talk about the industry essential sector, the company is the largest producer of stearic acid and glycerin. Now let us have a look at the financial statements of the company. The revenue seems to be increasing from almost 28,700 crores in 2019 to 37,000 crores in 2021, with a very constant operating profit margin despite huge fluctuation in raw material prices. If we look at the cash flow statement, we would find that the company has been undertaking huge capital investments and has also been repaying long-term borrowings, reducing debt to equity ratio to 0.6 times. While we totally acknowledge the agroclimatic risk relating to the product of the company, the risk owing to the volatility in the prices of edible oil, along with the exchange rate fluctuation and its presence in a very competitive industry, we still believe that the company has the potential to stand out of its competitors and have better control over the risk. And thus, these were the reasons why we chose to buy this company in the very first place.